Ever feel like you're just drowning in information, and you wish someone could just sort of pull out the key bits for you?
Yeah, absolutely. Especially with complex stuff like business performance. You just want the bottom line, right?
Exactly.
Mm.
And that's what we do here at the Deep Dive. We take those dense reports, the earnings calls, and try to, make sense of it all.
Give you the actionable insights without you having to wade through everything yourself.
So today, we've got a request from a listener. We're looking at Jay Bee Laminations Limited. They make CRGO steel cores.
Right, cold-rolled, grain-oriented steel. Super important for power transformers, making them efficient.
And we're digging into their recent performance H2 and the full financial year that just ended March 31st, 2025. We have their earnings call, transcript, and investor presentation.
So think of this as your quick guide to what's driving JB, the bumps in the road they're facing, and where they're headed. Useful stuff if you track the power sector.
Definitely. So our mission today, pull out the most important nuggets from those sources about JB's performance, their challenges, their plans, make it easy to grasp the big picture. Ready to jump in.
Let's do it. So the basics first. JB Laminations, they started back in 1988.
Oh,
Based out of Noida and Greater Noida, that's in Uttar Pradesh. They've got 3 manufacturing units now.
3 units, yeah.
Unit I and 2 are up and running. Combined, they can put out about 18,060 metric tons a year.
Sounds like a lot.
It is. And Unit 3 is just about to start commercial production probably this month, May 2025. That adds another 1,200 tons.
Okay, so capacity is growing. What are they actually making in those units?
Mostly cut laminations, that's like almost 80% of their business. Then assembled cores, maybe 16%, plus some slit coils, other bits. But the focus is really value addition for transformers.
Gotcha. And where do they sell this stuff?
All over India, plus they export, they mentioned 10 plus countries, US, Saudi Arabia, Oman, Nepal, Bangladesh, places like that.
So decent global footprint too. Who's buying from them?
Their customers are the ones who then supply the big power players, Adani Power, Tata Power, Power Grid Corporation, PGCIL, and the state utilities too.
Ah, okay. So they're a key part of that supply chain.
Exactly. And they've got the credentials ISO, BIS certified, Star Export House status. And critically, they got PGCIL approval for up to 400 kilovolts, 400 kV.
That 400 kV approval sounds important.
Oh, it is. It opens up bigger, higher value projects in the transmission sector. It's a quality benchmark.
Right. Okay, that gives us a good foundation.
Yeah.
Now let's talk about this past financial year, FY25. What were the highlights, the wins?
Well, first off, they had a successful IPO. That's a big one.
Definitely sets the stage.
And operationally, strong volume growth. They hit 12,400 metric tons. That's up 32% year on year and bang on their target.
Wow, 32% volume growth. Did revenue follow?
It did. Revenue was up 21%, hitting 368 cores.
Okay, good top line growth. How about profits?
Also looking healthy. EBITDA, that's earnings before interest, taxes, depreciation, amortization, grew 36% to $430 million.
Nice.
And profit after tax, PT, was up 31% to about $254 million.
So strong growth across the board, really.
Yeah, and they improved their gross margin, too, by about 200 basis points to nearly 19%. Plus, they brought their debt-to-equity ratio down significantly.
Debt to equity improved.
Yeah.
It's good financial housekeeping.
Yeah.
What else stood out in FY25?
Well, that PGCIL approval for 400 kV we mentioned, that came through in March 2025 for Unit 2.
Okay, right at the end of the fiscal year.
Exactly. And it had an immediate impact. They secured 17 crores in orders in April, just after the year ended, and they said another 15 crores was under negotiation.
So that approval quickly turned into business.
Seems like it. They also got approval from REPDCL, the Rajasthan State Utility, and the expansion they were doing at Unit 2, a brownfield expansion, that finished on time in October 2024.
Good execution on the expansion.
And they ramped up utilization pretty well in the summer and a half. Oh, and Unit 3, the new one they got trial runs, started super fast, within like 4 months. Commercial ops expected this month, May.
Things moving quickly then.
Yeah, and one more thing, they added some new clients. Apparently, these new customers accounted for about 12% of their sales in FY25, including BHEL Bhopal, specifically for the 400 kV plus range.
BHEL Bhopal. That's a big name, especially for higher voltage stuff.
Oh.
Okay, so a lot of positives in FY25 overall.
Definitely a year of significant progress.
But, it's never all smooth sailing. Let's get into the details a bit more, maybe the second half of the year. H2 FY25, you mentioned margins.
Right, this is where it gets a bit more nuanced. While the full year looked good, the margins in H2 were, well, lower than expected.
Lower. How much lower?
Their profit after tax margin in H2 was 5.12%, which compared to H1 was a noticeable dip.
Okay, 5.12%. What drove that dip?
The main culprit was volatility in raw material prices, specifically CRGO steel.
Ah, the key ingredient, price swings.
Big time. The average purchase price went from maybe 190 euro or 200 per kilo, jumped up to around 255, then eased back a bit to 230 euro, 235.
That's quite a range. How did that affect them?
Well, they built up quite a bit of inventory in the first half of the year, like 90 crores worth by September.
Stocked up. Why?
Partly because there were some temporary license issues with a few steel mills they buy from, and partly because they were expecting higher sales in H2 and wanted to be ready.
Okay, so they bought a lot, presumably when prices were heading towards that peak.
That seems to be the case. They bought at higher prices, and then they were using that more expensive inventory in H2, even as market prices perhaps started to soften slightly.
Ouch. So that squeezed the margins.
Exactly. And they mentioned it was hard to immediately pass on those sharp price increases to customers because of existing orders they had already booked.
Right, there's always a lag. Did they manage the inventory down?
Yeah, they got it down to 76 crores by the end of March. And they're aiming for like 60, 65 days of inventory going forward. So optimization is happening.
Okay. How did this translate, like, per ton? Did they track that?
They did. Their EBITDA per ton really shows the difference. In H1, it was around 41,000. But in H2, it dropped to about 30,000.
Quite a drop. But they're sticking to their long-term guidance.
Yeah, despite the H2 pressure, they maintain their long-term guidance for EBITDA margin, aiming for 12% to 13%.
Okay, so a bump in the road with margins, but they seem to see it as temporary. Looking ahead then, what are the plans? How do they keep growing and maybe manage this volatility better?
Their strategy seems twofold. Keep pushing volume growth, but also diversify strategically.
Makes sense. What are the volume targets?
We're aiming for 30% annual volume growth for the next 2 years, FY26 and FY27.
30% again. Ambitious.
It is. That means hitting around 16,000 tons next year, and maybe 20,000 the year after. They say their current monthly run rate, about 1,300, 1,350 tons, supports this goal.
Okay. And approvals. You mentioned PGCIL 400
Totally.
kilo. Anything else?
Definitely. They're targeting approvals from NTPC, Torrent Power, and they want to get PGCIL approval for the next level up, the 765 kV class, hopefully by FY26.
765 kD. That's serious high voltage.
Right.
More approvals mean bigger markets, right?
Absolutely. Wider potential customer base, potentially higher value contract.
And capacity. Unit 3 is coming online. Any more expansion planned?
They mention optimizing Unit 2 further in FY26, which should get them to that total capacity of 23,340 tons per year. Unit 3 technically has space for more expansion later, maybe up to 12,000 tons total for that unit alone, but right now the focus seems to be optimization and diversification.
Diversification how?
This is interesting. They're planning forward integration in Unit 3, not just making the cores, but moving into core coil assemblies.
Okay, the next step up.
And even making actual transformers themselves. Small, special application ones, mainly for export.
Whoa, transformers. That's a pretty big step, isn't it? Moving from component supplier to finished product.
It is. They said they've got a commitment from an export customer for like 15 euro, 20 crores worth annually, expecting initial orders, maybe 3 euro or 4 crores in FY26.
What kind of transformers are these? Big power ones.
No, smaller distribution transformers. For industrial or household use, they said. It's a higher margin business, apparently, though starting small.
Higher margin. That can help with the volatility issue.
Potentially, yes. And one more thing to support this, especially the higher KV stuff, they've set up their own in-house CRGO testing lab at Unit 2.
Ah, quality control in-house.
Right. They're aiming for NADL accreditation, that's the official lab standard board, by the first half of FY26. This reduces reliance on third-party labs, speeds things up, and is important for keeping that PGCIL 400 kV certification valid.
Makes sense. So a lot happening strategically. Let's zoom out a bit. What's the broader industry like, the context they're operating in?
Okay, big picture. The market for high-voltage power transformers is expected to grow. Projections are around 6.6% CIGR over the next decade.
Okay, decent growth.
And for the overall power and distribution transformer market in India, the growth forecast is even stronger, maybe closer to 11% CIGR through 2030. So the underlying demand seems pretty robust.
Good tailwinds then. Any headwinds?
Well, there is this question mark about potential oversupply in the CRGO lamination space itself.
Ah, because JB isn't the only one expanding capacity.
Exactly. Several players are adding capacity, chasing that strong demand. That could, put pressure on pricing and margins down the line if supply outpaces demand growth.
Classic industry dynamic.
Yep. And there's the split between organized players like JB and the unorganized sector. The larger transformer manufacturers increasingly prefer organized suppliers for consistency in quality and reliability, especially for large volumes.
So that benefits players like JB.
It should. Also, while some big transformer companies could integrate backward and make their own cores, it's complex. Managing all the different grades of CRGO, dealing with scrap, it's a headache.
Right. Inventory challenges.
Exactly. So even integrated players often still buy cores from outside suppliers like JB for flexibility.
What about raw material supply? Any long-term worries there beyond price? You mentioned those BIS license issues briefly.
Management didn't seem to think raw material availability would be a major bottleneck, despite potential short-term license hiccups for some international mills. The global CRGO supply seems adequate overall.
Okay, so demand looks strong, supply seems manageable, it supports their volume goals.
For now, it seems that way, yes.
All right, let's connect this back to their finances. How's their overall financial health looking to support all these plans?
Well, as we noted, the IPO helped. Their total equity and total assets increased in FY25.
Right.
Fixed assets went up quite a bit, too, because of the CapEx, the spending on those expansions around €19, 20 crores.
Makes sense. Inventory.
Inventory went up in value, as we discussed, because of the stocking and prices, but they're actively working on optimizing those levels.
Okay. And receivables.
Yeah.
Money owed by customers.
Trade receivables increased. They mentioned it was around 70 days of Q4 sales, but they also pointed out a good chunk of that is backed by letters of credit or credit insurance.
Some protection there.
Mitigates the risk somewhat. And crucially, that debt-to-equity ratio improved to 0.16x, which is quite low. Management said they want to reduce debt even further.
Okay, so financially, they seem reasonably solid to pursue these growth plans.
Yeah, the foundation looks pretty sound.
So, bringing it all together, what are the key risks and opportunities you see for JB going forward? What should you, our listener, keep an eye on?
Okay, risks first. That raw material price volatility is definitely still a big one. It hit them in H2. It could happen again.
Always a factor in commodity-linked businesses.
For sure. Then there's the potential industry oversupply we talked about. If everyone expands too fast, margins could get squeezed for everybody.
Right, competition heats up.
There's also execution risk. They're moving into new things like transformer manufacturing.
Yeah.
Can they execute well on these new ventures? And the transformer industry itself can be cyclical, so demand might not always be this strong.
Okay, those are the main risks. What about the opportunities? The upside?
Well, the growing transformer market itself is a huge opportunity, driven by power infrastructure spending.
The rising tide.
Exactly. And moving into higher kV products, like the 400 kV and maybe 765 kV, generally offers better margins than lower-rated products.
Value addition pays off.
Hopefully. The forward integration into core coil assemblies and those export transformers, that's another potential avenue for growth and maybe better margins. Plus, they can continue to gain share from the unorganized sector, and expanding exports provides diversification. Lots of potential upsides, too.
Okay, that's a great overview. So let's try to distill this down. For you, our listener, what are the absolute key takeaways from this deep dive on JB Laminations?
Right. The main things to remember are, 1, JB showed really strong volume growth last year, which suggests good market demand. 2, their recent profits took a hit from those wild swings in CRGO steel prices. Something to watch.
Okay, growth plus margin pressure.
And 3, strategically, they're pushing hard. Expanding capacity for higher voltage stuff, and diversifying by moving further down the value chain into assemblies, and even making transformers for export.
Got it. Was there anything in the details that particularly struck you as interesting or maybe a bit surprising?
I think the definite push into actually manufacturing transformers, even small ones for export, is quite noteworthy. It's a significant strategic shift, moving beyond being just a component supplier.
Yeah, trying to capture more value.
Exactly. And also just how clearly those raw material price swings, tied partly to those supplier license issues, impacted their H2 margins. It really highlights the supply chain challenges.
So understanding all this,
Yeah.
how does it help someone listening get a better handle on things?
Well, it gives you a clearer picture of the dynamics in the transformer industry, right?
Hmm.
You see JB trying to balance strong volume growth with protecting profitability in what could become a more competitive space. You see their strategy playing out, moving to higher value products, exploring exports, managing those raw material risks. It helps you understand the pressures and opportunities for companies like this.
Makes sense. So final question for you to ponder. What's something to really chew on after hearing all this?
Maybe this. With all this new capacity coming online in the CRGO lamination sector, just how critical will JB's diversification into things like core assemblies, transformers, exports actually be for their long-term health and protecting those margins?
Good question. Is component manufacturing enough, or is moving up the chain essential?
Or maybe think about it this way. How will that ongoing raw material price volatility and any future regulatory tweaks keep shaping who wins and who loses among companies like JB Laminations?
Lots to think about there. Well, if this has sparked your interest, definitely check out the source materials for more detail.
There's always more depth if you want it.
Thanks for joining us for this deep dive.